Okay, I think we're all set for our special treat, our final speaker of the day and of the conference, our keynote speaker, Marcel Nutz. I'd like to introduce Marcel. Marcel is a professor in statistics and mathematics at the Statistics and Mathematics Department at Columbia University. His research is in mathematical finance and optimal transport. He's done a ton of work in all different areas encompassing those two topics. He's obtained his PhD at ETH Zurich under the direction of Martin Schweizer and did a postdoc with Meta Sonner. Marcel has a ton of accolades, including being named an IMS Fellow, an Alfred Sloan Fellow, a Columbia École Polytechnique Alliance Professor, and very recently was awarded the IMS Medallion. So he'll be giving the IMS Medallion lecture coming up. I'm not exactly sure when the date is, but
26.
When is it?
In 26.
It's 26. Oh my God. Okay, but it's been announced.
So you got an email. So, congrats. In 25, we'll tell you when you give your lecture in 26.
Right. So please welcome me in joining please join me. Sorry, in welcoming Marcel to tell us about optimal execution.
Thanks so much for the kind introduction, Sebastian. Thank you, Silvana, for organizing this great meeting. Is the microphone working? I don't hear myself.
Let's see if maybe the button is turned off. No, it's on.
It's working.
Okay, wonderful. Sorry, just not loud enough, I guess. Okay, this is the last obstacle before the dinner. So it's sort of a transaction cost, if you wish. So it's very fitting to speak about transaction costs. So it's going to be a not very technical talk. You can tell that it's end traders, so apparently it's related to games, and price impact, so it means it's about transaction costs. Okay, this is ongoing joint work with Stephen Campbell, who is sitting here, and more precisely, it's mostly work by Stephen, so that would be the more honest slide. I'm just presenting it. And maybe I want to acknowledge that this sort of started in conversations with Kevin Webster when we were working while he was gardening. At the time, we were trying to do something, then kind of realized it doesn't work, and now we're trying to figure out more precisely why it didn't work. Okay, the introduction. So there are the three parts here. Only the last one is about the paper. The middle one is sort of the introduction, background for the paper, and the first one is like general background, vaguely related to the paper that I thought, it's more like for your general education, if you wish, if you're not familiar with transaction cost kind of stuff. Okay, so here are some stylized features about stock exchanges and similarly structured security markets. Okay, if you go to a place like NASDAQ, the majority of the volume goes through the CLOB, the centralized limit order book. And the most relevant features of that are that it's lit and anonymous. What does that mean? Lit means that everyone can see the trades that happened. In addition, for most of the order types, you see even what is sitting in the book. So if I put a limit order and I use a standard order type, everyone can see it's there. Okay, anonymous means you cannot see that it's me. So if you see 100 different limit orders, you don't know if that's 100 different people doing that, or whether it's like one big guy that's actually trying to sort of hide and have many small orders. Okay, so these features are, maybe we don't think about them so often, but they're very relevant for how the transaction costs, how the market impact works, and so on. So if you go to something like corporate bonds, where usually it's like, you know exactly who is your counterparty and so on, it's completely different. Okay, so it's just to maybe remember that. Okay, so the second item is, okay, I just want to say that, okay, for me, transaction costs are kind of trivial. When I buy stocks, I log into my brokerage account, I place market order, essentially I'm paying a half spread, so there's not much ambiguity about that. But if you're executing institutional size order, then the cost is much higher than just a half spread. Okay, and so here are some vaguely, typical numbers. This is a very broad average. These numbers are for large cap stocks, so these are the most liquid stocks. So typical numbers are 5 basis points, so that means 0.05% of spread costs. If you talk to a friend at a sophisticated quant fund, maybe he will tell you, okay, maybe it's more like 3. Okay, so that's the order of magnitude, whereas price impact costs would be maybe 30 basis points for large caps. And if you go to slightly less liquid stocks, maybe small caps, it could be maybe 90. Okay, so we're talking about 1/3%, something like that. So if you are, say, a quant hedge fund, might trade very roughly medium size, maybe 1 to 10 billion US dollars per day. So 0.3% of 10 billion actually is a good amount of money. So it's enough to pay some quants to try to maybe reduce the 30 to 27, and that will actually, has a pretty serious consequence financially. Okay, so what's price impact? That's just the idea that when you buy, you tend to push prices up, and when you sell, you tend to push prices down. In this talk, it's all going to be about reduced form modeling, so you don't care about explaining how exactly that happens. You just assert that it does happen. Okay, the explanations are manifold. One could be that, okay, there is kind of benign liquidity, people like me buying and selling, and you're basically depleting some of that. It could be that the market is reacting to what you're doing. It's like, oh, I see Sebastian needs to sell a lot, so I'm going to like front run him, remove all my limit orders that he just wanted to use, and so on and so forth. Okay, but directionally, I think this is very intuitive. Okay, so the mechanics of that pricing cap, something that was briefly mentioned a bit this morning. So there are three keywords that come up in this context: instantaneous, transient, and permanent. Persistent also, but it's used sort of the same way as transient. Okay, so the vague idea is instantaneous is you push the price up while you trade, but when you stop trading, poof, it just falls down immediately. Okay, instantaneous in that sense. Permanent, you had it this morning, it's the opposite extreme. It's like I buy, I push the price up and just stays up there forever. And transient is in between, so you push it up, but it actually comes down again. Okay? So the dynamics of that impact are actually quite complicated, multiple time scales and so on. But just to give you one vague idea for execution problems, like the ones I'll be looking at, those could be set over a couple hours, maybe end of day. Okay, so a couple hours is that time horizon. So typical number would be that half of a trade's impact could dissipate 1 to 2 hours after you stop trading. Okay, so that's the kind of time scale that's relevant to us, because if we're setting a problem up over several hours, okay, and if it goes down by half, that's substantial. So that's something that we want to take into account. Otherwise, we're kind of not capturing important feature. Okay, then I realized I should have had the slides in other talks that I've given and I didn't. So let's see if it's useful. Okay, what's a typical pipeline here? So ideally, in math, okay, you want to do a joint optimization and kind of determine everything at the same time. There's a lot to be determined, like how fast are you going to trade, what's your time horizon, which venues do you send your orders at, use limit orders, market orders, which combination thereof, dark pools, blah, 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 everything. Okay, so it's a pretty complicated problem, and it's often structured into 2 steps. The first one is to determine the order schedule. So imagine that you determine you want to sell a cake, some number of shares, let's say, of a given security. You want to determine the horizon over which it will be executed. That can be a function of risk aversion. Maybe you're trading because you have alpha, it's decaying quickly, you want to trade faster, or you don't care, you want to pay less in transaction costs, you're not worried about the price moving, you make it longer, so on. Okay, the order schedule is how this cake is going to be distributed over this interval. And a typical thing to do is to partition this into bins of maybe 5 or 10 minutes. Okay, so the order schedule is really, for each of those little windows, how much quantity do I want to trade in each bin? Okay, that's the order schedule. And the kind of stuff that we'll be looking at is actually only about determining this schedule, not more and not less. Okay, in particular, I don't really care too much about what I'm going to pretend to be happening in this 5 minutes. I'm essentially going to bin it anyway. Okay. So here we will be worried about things like impact, because when you plan this block, you're certainly aware that if you're pushing up the price here, you'll be suffering from that when you do this one, okay? And that's what you want to focus on while doing that. Once I've done the binning, I will forget this and be myopic and only focus on, okay, how do I execute this? And now the simplification is I'm not going to worry about the fact that later, I still need to deal with this guy and this guy, okay? And while I focus on this one, so this is the so-called child orders. This cake here is called meta order, and then these are or parent order, and these are the child orders. Okay, then I'm going to worry about which of the many available values I'm actually going to send this to. I'm going to post limit orders at which price. Am I going to use market orders? Okay, like a typical thing could be, okay, maybe in the beginning of the block you try, you're trying to mostly not cross the spread. So you're just posting limit orders, and depending on how much gets filled, you will price more or less aggressively. And towards the end of this block, you kind of need to catch up with the schedule, and maybe you're going to use market orders if you're behind, and so on and so forth. Okay, but we'll be doing that sort of, not doing the impact calculation anymore. Okay, also we'll be using different venues, potentially try to exploit liquidity that comes up. So be opportunistic. Okay, so approximately hit the schedule is what I wrote there. Okay, so all this stuff is not something that we deal with in this talk at all. Okay, we'll just have it like in the back of mind. Actually, Sebastian's book deals with some of these problems. I also put another book here that you guys probably don't know about. There's very little math in that book, but it's relatively recent. So this is a book that you can read in one day. Seriously, and it's supposed to be kind of for beginning quants who are maybe doing alpha research or something. You should kind of know that this stuff exists, but it's not for people who want to specialize in execution. Okay, so I think it's useful. Okay, so okay, I was actually going to say two more words here. So back to the order schedule. What could be a typical order schedule? Okay, the most naive thing to do is what's called TWAP. It just means constant in time speed. So it means all these chunks are equal height. Okay, it's not very clear why calendar time would be particularly relevant to this problem. Okay, more reasonable and more frequent is that you want to be a constant fraction of the volume that's traded in the market. Okay, you want to be 1% of the market at any moment in time. Okay, that's the flavor of the VWAP and the POV. The difference between the two is often, I think that's misrepresented. So VWAP is usually that you're using the projected volume. Okay, so obviously volume is going to be, you don't know exactly in advance what the volume is going to be. So for that one, you're going to estimate the volume curve in advance at the beginning of your order, or maybe even the beginning of the day. Okay, then you do your schedule and then you run it. Okay, so the quantity to be executed is deterministic at that point. So you don't have risk of that. The risk is that, okay, maybe the volume is going to deviate from your projection, and then you're going to be a different fraction of the volume. Okay, the percent of volume is the reverse. You're trying to dynamically adjust to the volume as it changes over time. Then the risk is that you cannot plan as easily the quantity. Okay, and both are problematic if you start to be, if it's something illiquid and you are suddenly the whole market, then neither of the two makes sense. Okay, or you do something more sophisticated, which is the kind of model that we solve in this talk. Okay, single player models, two of them. Just some notation. I'm going to be looking at the simple optimal execution problem. I imagine that I have X shares at the beginning of the day, which could be negative. I'm going to put myself a constraint at capital T. T is already chosen, that I have to unwind completely the inventory by cap T. So XT is the inventory at time T. So this is basically how many shares I have in my book. I will imagine that I'm risk neutral. I'm just maximizing expected profit or loss, no risk aversion. Okay. I will assume that the fundamental price or unaffected price is a martingale. What does that mean? This is the price that would be happening if I were not trading. Okay, so this is very convenient. In fact, at that point, you can assume that the price is constantly equal to 0. Okay, because then the expected P&L is just purely transaction cost. Interrupt me if anything is not crystal clear. So that's because when you take expectation, actually the martingale increments have 0 expectation, so that's not going to affect our P&L. Okay, this is a standard setup for this kind of problem. If you have alpha, if you have drift, then you can work the drift into this problem. It's not going to change things too fundamentally. Okay, so this is one of the first models around. It's not the first model, but a very influential one. Umgren and Chris. So it's actually, they start in discrete time. I write it here in continuous time. So here in this model, you have, when you trade in absolutely continuous fashion at a certain speed or rate, VT, and your total transaction cost will be this here, the instantaneous cost, some parameter epsilon, and running square penalty. Okay. Another way to get to that is you think that P here is the unaffected price, the one that would be happening if you weren't trading. Then if you trade at speed V, you push it up or down by epsilon times V. Epsilon is a number, and S is the price at which you actually transact. And then if you are buying with V at S, you do the math, you get to the square. That's how you get to the square. There are two interpretations of that instantaneous cost. One is that this is actually price impact, instantaneous price impact. So you're really pushing up the price mechanically. Okay, and it's instantaneous in the sense that I explained before. So you're trading at rate V. If you stop trading, then the next second the price actually fall down to the unaffected price. Okay, or actually much of the literature later, this is more of a reduced form idea that this is like something like a tax that you pay to third parties without actually elevating the price. As long as it's a single player model, it doesn't really make a difference. Okay, and in the Anger's paper, there's also permanent impact. So it's kind of the two extreme timescales. One is instantaneous, and the other one is never goes back. If you're solving an optimal execution problem with these constraints, you're not so interested in the permanent impact. The reason is that it's not going to affect your strategy. Okay, the permanent impact, hey, there's probably the one thing that everyone agrees on in this business is that permanent impact is linear. People don't agree whether permanent impact exists, but everyone agrees that if it exists, it's linear. That's for an arbitrage reason. Otherwise, you can think about that yourself. So if you have permanent impact, then any strategy is going to pay the same amount of permanent impact cost. So it will change your cost, but not your strategy. That's why it's okay to not consider it. Okay, so if you solve this model, then just by convexity, the best thing to do is have V to be constant, right? And so then because T is given, then this will be your constant trading speed. So this brings you to the TWAP strategy, the constant in time one. Okay, this does not capture the decay of impact that we talked about before. So the simplest model that captures that transient impact is the OBJ/Wang model. So this model has only one time scale and the decay is exponential. That's a dramatic simplification of the reality. I think everyone agrees that that's not necessarily the statistical reality, but it's by far the most tractable model. And for that reason, it's used quite frequently. Using this one, you'll be doing much better than using just a model without transient impact. Okay, so how does it work? The idea is we model how much we are pushing the price away from where it would be if we were not trading. Okay, so that I is exactly the dislocation of the price caused by us, by our trading. And so the way it works is, okay, so firstly, the second line is saying what I just said. Essentially, this says that the actual price is this fundamental price plus I. I is the impact process. And you have this strange formula. This is just IT as long as there's no jump at T. Okay, so what's the dynamics of T? The idea is that if you trade an amount dx, then you're pushing up the price immediately by lambda dx, right? And then it will come down exponentially at rate beta to where it would have been before if you don't do anything. But probably here you make another trade, right? And you actually have the sum. So you get this exponential moving average of all your past impact shocks. Okay, that's the idea. And you get to the price by adding this to what would have been the price without your trading. Is that clear? Okay, kind of OU dynamics. Okay, so in this model, you don't have to trade in an absolutely continuous fashion. You can also, have a block trade, which means that you have a chunk at a particular time. The model doesn't really care, and it does that in a consistent way. So whether you trade 100 shares sort of very quickly over a very short period of time is essentially equivalent to just using the 100 at the same time. Okay, so if you solve this, then instead of the TWAP, you get a strategy which has a constant speed on the time interval, on the open time interval 0t. But in addition, it makes block trades at the initial time and at the terminal time. So these times are special because in the beginning, you want to, okay, here I started from 0 impact, which actually I don't have to, but let's just assume that there's 0 impact. I didn't sort of trade before this problem started. Then I have that block. Why? Because the resilience is good for me. So I want to get it started to work for me. That's why I'm first pushing it with a block trade. And the terminal time is special because after the terminal time, you don't need to do anything. So you're not going to suffer from the elevator price that you caused there. Okay. And if you wish, you can parameterize it differently through the impact, but I'm not really going to use this here. So let me not elaborate too much, but there's a different representation where in the optimal strategy, you keep the impact constant in time. So that's very easy to remember. There's sort of a target impact state where you want to be, and you just keep it there. That's the optimal strategy. Okay, we can combine the two. Okay, so we just keep the impact costs exactly as I just discussed. Here it is. And then on top of it, pay the instantaneous cost. So now we have at least two timescales. We have the very short one, and we have the intermediate one. Okay, so you realize that when you push beta to infinity, maybe I should have said this here, if you push beta to infinity, basically you come down immediately. That's the instantaneous impact. If you put beta to 0, it's permanent impact. So this is in between, it kind of interpolates. Okay, you could have a bunch of these exponential kernels, and then you really cover multiple timescales. Okay, so in this model, because there is instantaneous cost, the trading has to be absolutely continuous, no more jumps. Okay. In this model, we can still find optimal execution strategy in closed form. It's actually a bit more complicated, but doable. And I think the picture probably says best what's going on here. So this picture, I stole it from the paper of Grave and Horst. So this was probably pioneered by this Garliano-Peterson paper, and later by Grave and Horst. So this is from their paper. So the dashed line is the Almgren and Chris strategy. So what is this? This is the inventory. You start with inventory one. You have to bring it to 0 at the time horizon. So this is constant speed, brings you down along the diagonal, right? Then the greenish curve is the OBJ/Wang, where you make a block trade in the beginning, then constant speed, then block trade. The parameters are a bit extreme. The block trade with reasonable parameters is not as big. This is just so you can see what's going on. And then what is called eta is what I called epsilon, which is the coefficient in front of the instantaneous cost. And the point that the picture is trying to make is that for small parameter values, you're essentially just smoothing the OBJ/Wang solution. Okay, so when you combine the two costs, because you're penalizing the trading speed, you obtain a smoothing. Okay, so some people call this a regularization of the OW model. In the OW model, it's often criticized that it has these block trades, and those are not realistic, and you would not use those in the market. So maybe you want to get rid of them by smoothing. On the other hand, if you remember, and that's why I said this, if you're just trying to determine the bin quantities, you realize that if you bin the whatever yellow curve, you obtain essentially the same values for each bin, right? So at that point, and that's kind of Kevin's point that he convinced me of, it's much better to use the very tractable strategy model, which is the OW model, and work with it. Anyway, you're not going to take it as seriously as, oh, I need to throw this block onto the market now, especially not on a lit exchange, right? Okay, so yeah, the bin version of the strategy is quite similar. We see the convergence when epsilon goes to 0. And sort of what's happening is that this instantaneous cost that we added as a regularization, the value of this converges to 0 if I take the optimal V, which depends on epsilon, and send epsilon to 0. Okay, now the actual talk starts. Okay, so we're interested in game kind of setting with n agents. Now they have initial inventories xi. So I is the index for the agents. It's not a power. Inventory is called capital Xi. They're going to be similar as before, risk neutral and everything. This is a game where the interaction is through the price. How? Because if I push up the price and later you trade, you are going to trade at the price that I changed. Okay, so the interaction is through that mechanism. It's not direct, but it's through the price. So specifically, the impact is defined as before, which kind of makes sense. So now here, just I replaced dx by the sum of the dxi's. Why does it make sense? Because this is anonymous. So anyway, no one knows where this trade came from. So that's why it makes sense. That's why I try to emphasize the thing is anonymous. Okay. We're still going to have the instantaneous cost. And now it's important that it's paid to third parties, which means it's like a tax is burned. We're not pushing up the price. Now it matters because if I push up the price, then it affects you. And this actually does not affect you. Okay. We're going to be looking for open loop Nash equilibrium and emphasize this is the full information setup. Okay. This is actually a big caveat. Okay. So we're assuming that everyone knows who else is in the market and their inventories. This is probably not what's happening. But it's the easiest setup to analyze for sure. If you're looking for a situation which approximates this at least a little bit, you can think of situations like when the S&P 500 index changes, that is sort of pre-announced, and it's more or less known what's the total volume in these things. There are plenty of index funds, mutual funds that are going to have to adjust their position, and they do so mechanically. So then, if you are an event-based desk in a hedge fund, this is the kind of thing you want to trade. You specialize in this, you have an idea of how much volume is going to trade, roughly around which time, and you're sitting there trying to be a predator. And that's one thing we can look at, how costly that predation is. Okay, and actually the mutual fund is okay with that because they only care about the benchmark. They're actually not that worried about losing dollars as long as their target is to track the benchmark. Okay. So what we want to do is we want to study such games in some model, for instance, OW model. And the hiccup is it doesn't work. Okay, so let me start with something that works smoothly, sort of. So this is the combined model. We have the OBJ1 thing, that stuff, okay? And we also have the instantaneous cost with some positive epsilon in front, okay? So all the agents are trading in an absolutely continuous fashion. I don't have to talk about splitting ties because for the infinitesimal quantities, it doesn't really matter who is before the other one. Okay, so here's the theorem. There's unique equilibrium, and it's a closed form. The form is like this. Basically, what matters is the inventory is xi, and the average inventory over all agents, x bar. There are time-dependent deterministic functions ft and gt that can be found in closed form, and they multiply it this way. So the f and g don't actually depend on the xi's. So there are two extreme cases here that are sort of special. One is if everyone has the same inventory, then this first term is zeroed out. If the inventories add up to 0, the second term is zeroed out. And otherwise, you have like a convex combination of these two extremes. Okay, so how does it work? The problem can be set up with general stochastic strategies. And then there's some technical work to show that there is uniqueness. Okay, but it's actually hard, but Stephen did it for you. So you use it as a black box. So once you know that, you only have to identify one equilibrium. It's going to be the equilibrium. And you can do that. You kind of do a perturbation approach. You get an ODE, and then, which is not trivial, Stephen can solve the ODE for you. Actually, it's very difficult to find the eigenvalues and eigenvectors for the system. It's humongous, by the way, but I'm not showing it, so it's fine. And okay, there's your equilibrium. Okay, so the existence of equilibrium is not impressive. It's probably known before. I think it's known before, yes, but explicit solution was not known. And it seems that this relates to some fine details and Stephen's capacity in using Canadian computer algebra software. Okay, so it's cool. If you need to implement it, it's closed form, so you need it. If you want to analyze something analytically, it's really a big expression. So his joke is that we'll add a footnote to the paper, like our hearts go out to the reviewers, assuming that they check the formulas, which I'm sure they don't. Anyway, so we want to follow the scheme from the stuff before. Actually, we wanted to use the OW model to have something simpler. And anyway, thinking or hoping that that is roughly the same. Okay, so of course we can just consider the model without that regularization, just epsilon equal to 0, just have the OW cost as before and write it down. Okay, before I do that, I should show you the picture of the equilibrium we just solved. So what should you have in mind? So here there are 3 agents. 2 of them, they actually have inventory they need to unwind. One has 10% and one has 8%. Think of this as being like the daily volume. So this is sort of how much of the market you are. And this is how they trade out of it. And then there's a black guy. A black guy is a pure predator, has no inventory, and is just trying to make money from the fact that he knows that these guys need to. So he knows that these guys will be selling. So he knows the price is going to go down. So what you want to do if the price is going to go down, you want to open a short position, and then when the price has gone down, you want to cover your short and make money that way. Okay. In the picture, it looks like that. Surprisingly, maybe the first bit of every path actually looks kind of the same, no matter what's the initial inventory, and that's actually approximately true. Okay, so sorry, I should have said that much before, probably. For those of you who've never thought about this kind of game, what's going on really is, okay, let's say even if there were not the black guy, just the first 2 guys, I know you're selling, you have to sell, I have to sell. we all know that when we sell, the price gets pushed down. So what's the general mechanics? Well, I want to sell before you and you want to sell before me. So it's sort of trying to front run one another. If we sell too quickly, then we have a huge impact cost. There's going to be some in between, and that's what's happening here. So you expect that in the game setting, the trading is going to be more aggressive than in a single player setting if, let's say, our trade direction is the same. If we're going to trade in opposite directions, actually you're helping me, then it's different. Okay, so that's kind of what's happening here. And then the black guy is a bit different because he doesn't need to do anything. He just knows that the other ones need to trade out. So he is essentially front running part of those trades and then back running at the other end and making a round trip profit. Okay, if you're the black guy, then the fact that the other ones are there is essentially an alpha signal. Your alpha signal is that the price is going to go down, and this is how you exploit it. Okay. 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 So we want to do the OW model without instantaneous cost. It's not really necessary, but useful to think a bit about what happens when two block trades happen at the same time. So we have to break this tie somehow. And we do the obvious thing, which you can say in different ways, but it's always the same math. Okay, so one way to say it is that priority ties are split uniformly. Flip a coin. Okay, or you can just say everyone trades at the price which was previously defined with the impact process I. That amounts to the same. So there's not much to do in terms of math, but it's maybe still good to think about how this sort of happens mechanically in this model. So if Silvana needs to unwind 100 shares, and I need to unwind, did I say 100? Okay, 200. Let's say I have 200. Okay, now, and we make this block trades at the same time, then okay, it's happening at one instant in time, but you can still think about it in terms of the model. It's the same as imagine you had some sort of slow-mo. Okay, then the way it happens is like she trades one, I trade two, and each one pushes the price up. Then she trades one, then I trade two, and so on and so forth. Okay, so that the prices that come out of this math are equivalent to that. So it's some of her trades happen before mine, some of my trades happen before hers, and this is going to matter. Okay, so now the theorem is there's no equilibrium. There's no equilibrium unless all the initial inventories are 0. So if no one has anything to trade, then actually no one wants to do anything, and that's an equilibrium. It's not very interesting. Okay, so the theorem is that unless we're in that situation, there is no equilibrium. There's no equilibrium, and this is my pre-dinner explanation, which is not the way that Stephen proved it. Okay, it proves different, and this doesn't probably fully make sense, but if you don't think about it too much, kind of reasonable, I think. Yeah. Okay, so I'm going to argue that equilibrium strategies cannot be continuous, and then I'm going to argue that also cannot have jumps, and then something is wrong. Right? There's not much left. Okay, so imagine that I imagine that you guys all use continuous strategies, and Nash equilibrium is I fix you and I re-optimize myself, right? So this should be for me very similar to the single player problem that I discussed in the previous section. Remember, there the solution was jump, constant speed jump. That was without alpha, martingale case. Now that you're trading, there is a drift in the price, and this will be modified. But because you're trading in a continuous fashion, the drift is going to be somewhat nice, and I very much expect that there is still going to be jumps. I didn't actually do the calculation, but I'm sure it can be done, and that's what comes out. Okay, there should still be a jump. But if my optimal reaction has a jump, that it contradicts the fact that this thing that I started with was an equilibrium. Okay, so that was not an equilibrium. Okay, so that's the first item. Then I want to argue that equilibrium strategies cannot have jumps. Actually, I'm not rigorously arguing that. I'm just going to, okay, I assume maybe that there are only 2 players. What I need to assume is that the sum of you guys has a jump. If there's only one, then it becomes equivalent. Okay, so if you have a jump, then it's not too hard to see that I can make an infinite profit. So it's easy to see if your jump is sort of in the middle of the time interval. Let's say you're buying in a block trade, then I basically want to buy a little bit before you and sell it afterwards. That's going to give me a round trip profit, and actually I can scale this infinitely, and things are going to blow up. It's a bit harder to see when it's, for instance, at t equal to 0. But then it's kind of like this game I was explaining with the 1 share, 2 share, 1 share, 2 share. So I'm trading at the same time, but actually I'm sort of front running part of your trade. And in this fashion, I still make a profitable round trip trade, which I can scale to infinity. And then again, no equilibrium. Okay, so that was intuitive proof that no equilibrium exists. For mathematicians, it's very natural that everything should be symmetric, and we're going to split the ties symmetrically. Kevin has an argument in his book on price impact from last year that teams should be pessimistic and assume that you're always the slower one, something like that. So we set out to prove that that will restore the equilibrium, okay, but it actually doesn't work. So it's not as easy as just changing the priorities. But it's related to this intuition. So then I spoke with him since we were working at the time, and it's like, oh, actually, I'm not really thinking that. What I'm thinking is that there's a different type of player also in the market, some high frequency, Citadel Securities type player who is gonna pick on you, and there's gonna be sort of an extra cost to this fast trading, and maybe that's closer to the way we implement the solution. Okay, so that's kind of strange, right? So in the pre-limit, it's beautiful. We didn't write the formula, but this unique equilibrium for each epsilon, we send epsilon to 0. We expect to find the equilibrium of the limiting model. So what's going on? There are different things that could be going on. Maybe the limit kind of goes to infinity or oscillates or something crazy like that. Or it actually converges to something, but that's something just not the equilibrium of the model we expected. So now there's two options. It's not the equilibrium of anything, or it's the equilibrium but of a model that we still have to discover. Okay, so it's the last thing that's true. And I'm going to discover the model on the next slide and then state that it is actually the limit. Okay, so this model is going to look a little funky. It's a warning. It's like when the sommelier comes with the orange wine. But if you believe that the pre-limit is reasonable, okay, it's widely used in the literature, it's a reasonable model, okay, then that in some sense justifies the limit. Okay, so fixing the existence, we're going to fix the existence by putting a little bit more sand in the market. So the problem before, like when I was contradicting the existence is, I make those round trip trades even with the block trade, and I make infinite profit. So we're going to make those block trades more costly, and then I cannot make things like those costs are actually going to remove exactly what I would be gaining in that arbitrage. Okay, it's pretty intuitive. You add a cost, it's hard to have the arbitrage. Turns out that if you put the cost too high, then you also destroy existence for some other reason. What it will turn out is that there's a magic number or two magic numbers that will restore existence, and nothing else will restore existence. And that justifies these magic numbers that we're going to pull out of the sky. Okay. Okay, so the additional costs that we add are quadratic costs, like everything else in this model. And there's going to be a coefficient which is called theta. Okay, we're not going to see block trades on the open time interval 0t. Maybe just leave me with that so we don't have to worry about it too much. What we're going to do is we're going to add extra costs at the beginning and at the end. And awkwardly, the cost depends on the number of players. Presumably, that's the reason why in 10 years of literature, no one has found that, because too awkward to even think about it and write it down. But conveniently, when there are two players, you do the math, is the same number, is lambda over 2. Lambda is the push factor. Lambda is this lambda. Okay, so if we just introduce those costs, we are mathematicians, we can do that. Yep.
In between 0 and t, there could be anything that's found.
Yeah, it doesn't really matter. No one wants to make a block trade in some sense. So yeah, you can put a cost or not. It doesn't really matter. Yeah, exactly. Okay, so in this modified model where we have added those strange costs that Stephen kindly found for us, there is a unique equilibrium. It has a similar form as before, except that f and g are now different time-dependent functions, and they're easier now. They're in fact so easy that if I really want to, I can write them down. This is very easy. It's much more tractable. And so two observations you can make sort of immediately by looking at it are those two here, that indeed in this limit model, the opening, what the hell? The opening block trades are actually exactly equal for all agents. Kind of funny. The first thing you do in the market, your first trade, actually is independent of what your goal was in terms of unwinding. It's purely driven by what the presence of your competitors in the market. And at the closing time, it's not like that, but it's the sum of all the block trades that will sum up to 0. Okay, so that's what it looks like. Sort of a jumpy version of what you saw before. For instance, the red guy starts up here, makes a block trade to come down here, then trades along that path, and then there's a block trade here. And similarly, before this guy was doing something like this, now there's a block trade, almost straight, and then up. So that's what this trade looks like. Okay, I promise that there's some numbers and only those numbers, so this theorem makes that precise. So for those particular numbers, we had equilibrium. What does it say is that if you choose different numbers at the beginning and at the end, you will never have equilibrium unless no one has anything to trade. And these other two lines say that, okay, if you want to change one but not the other, you will have existence only if the initial inventories are the same or add up to 0 respectively. And what's going on there is really kind of, you're in a trivial case where, okay, remember we had those extremes where only this or only this really matters. Okay, basically you're allowed to choose the wrong cost only in the event where no one was going to trade then anyway, so it doesn't matter what you put. Okay, so it's really, essentially you have to put these numbers and nothing else, otherwise it doesn't work. Okay, so that's this model that we identified that corresponds to the limit of the equilibria. And actually something a bit stronger is true. So firstly, okay, I'm stating here formally that, okay, I started with the model with epsilon instantaneous cost. I introduced this strange model with the block costs. What I'm saying here is that the equilibria converge in the sense that the inventory process, the capital Xi's, they converge. Of course, the trading rates do not converge because they blow up. Okay, but the cumulative trading, it converges. That's what I'm saying. And actually more is true. And then for a mathematician, at least, it becomes more natural what's going on. Namely, the costs actually converge. So in a gamma convergence sense, these models do really converge. So what's going on is that we had those instantaneous costs. Okay, so if you plug in the V, the optimal V for each epsilon, then this number actually converges to a non-zero quantity. And this non-zero quantity is exactly the additional block cost that we added to it. So in order to make this a continuous thing, like actually from a gamma convergence perspective, otherwise it's discontinuous, we have to recreate this cost somehow. Okay. What's probably fooling us in the beginning is that in a single player case, when we send epsilon to 0, these quantities actually converge to 0. So we don't have to replace them in the limit somehow. As I was trying to emphasize, in a game case, we expect trading to be more aggressive. And it is so much more aggressive that really sort of, right? So basically, if this L squared L2 norm here goes to infinity slower than 1 over epsilon, then this thing is going to go to 0. So that's what's happening in the single player case. And we actually have a more precise bound. If you wish, you can pick me on that. But in the game case, actually, this really converges to infinity at the same speed as 1 over epsilon. So then this whole thing goes to a constant. And the constant is what we are recreating with that additional block cost. Right? So the trading in the beginning gets steeper and steeper, and then the cost converges to something non-zero, and we just added back that cost. Okay. And here is what the convergence looks like in a beautiful graph. How does it work? There are the same 3 players. The lighter colors correspond to bigger numbers of epsilon, so stronger regularization. And you can, of course, see that when epsilon goes to 0, you really approach this jumpy equilibrium here with the darker and darker font. So you see the convergence is kind of nice. It will be uniform and compact, of course, only in the interior. Here at the boundary, it has a singular thing. But once again, you go back to the binning, the bins look the same. The bins look the same, so you don't have to worry too much about distinguishing jumps and not jumps from a more practical point of view. Okay, so we have the fairly tractable limit model. Here's an example of something you could write down. You could ask yourself from the beginning, what is the cost of predation of the fact that there are these predators around you, like in the mutual fund versus event-based trading example I gave in the beginning. So here I'm stating it if there is only one mutual fund, but you could do the similar thing for many. Okay, so here assume that you are agent 1, you have X quantity to unwind, bring it to 0, and there are n-1 other agents, they have 0 inventory, so they're just preying on you. It is probably intuitive that the presence of the predator will have a cost to you, and probably when there are more predators might be even more costly, but we can write down what it is and see what the result is, okay? So what is the additional impact cost? Just the impact cost, and expressing it in the, okay, this is the relative excess cost, I guess. So this quantity, if it's 20%, what it means is that your cost is 20% higher than what it would be if you were alone in the market. That's what we're trying to say. And okay, there are some very simple formulas and some limiting regimes, but maybe it's more useful for you to just see the plot. So the effect depends on the beta, on the resilience, or beta times t. T is 1 here. All that matters is beta times t, and of course number n of how many predators there are. More predators are worse, but not more and more. So basically this saturates. You see this kind of converges and is infinity at the highest curve. So the worst it gets is, you know, it's never worse than twice the cost, basically. Because, you know, the predators are kind of competing and their profits are actually diminishing with n. So that's one thing we can look at. And okay, so there were some related papers in the footnotes, but let me talk about actually the most related papers I didn't talk about. Okay, so there's a literature that is very closely related. It does not look at this vanishing regularization at all. Instead, it starts in discrete time and looks at some types of high frequency limits. Okay, you can say discrete time is also like adding some friction. Maybe, you know, the non-existence just came from continuous time. If you put discrete time, then everything exists and whatnot. That's actually true. So that's how we started naively. 3-period model, write it down, solve it. We can do it. And, you know, it has uniqueness and existence, but you should not be happy with that result. You should look at what it is. And the result is, I forgot, it's ridiculous, right? It's something like you first sell everything in the first period, then you buy back the same amount in the next period, I think, and then you sell it again. Is that roughly true? Yeah, I think that's what happened. So it's completely, yeah, no one would ever do that. It's completely insane, right? So it has existence, but it's still not good. Okay, so the first one to notice that is was Thorsten Schöneborn in his PhD thesis, very nice thesis. So he noticed that somehow this doesn't work, and then just said, okay, it doesn't work. This paper of Schied and Zhang, there's something similar. They look at more general decay kernels, so not only this exponential, and it's a mostly numerical paper. So they find also that there are these oscillations. So actually, I gave you this crazy example for 3 periods, but if you change it to 4 and 5 and 6, you will see some very strange oscillatory behavior. Okay, and they look at that in more detail. And well, the difference between the first 2 papers is that Schöneborn says, okay, here the math doesn't make sense. And in Schied's paper, they kind of want to see this as real economics. So it was the flash crash. And so they're trying to say that this is kind of the hot potato game where one high frequency trader is just kind of pushing the stuff to the other one and forth and back. You can have your own opinion of what you support. In any event, the third paper here is the most sort of closely related one. I think it's a really excellent paper, very detailed paper. So this is analytical, not just numerical. And now it's focusing on the same exponential kernel. So they do like sets, you have a 0 capital T and more trading periods. So what they observe is that, okay, they look at the discrete time. In discrete time, there are only block trades, right? There's no continuous trading in discrete time. So when they add a certain additional cost, they realize that the oscillations get depressed and they can actually take a high frequency limit. And that high frequency limit is essentially the same that we find for n equal to 2. As you notice, for n equal to 2, you have to introduce one parameter, which is kind of mentally more beneficial. Okay, so that's that paper. For n players, there's only, I think, one paper, this later one, which works in a slightly different way. This is not a high frequency limit. This is like you're trading at integer dates, let's say, but they're adding more and more dates. So it's kind of like infinite time horizon limit. I think the reason they did that is that they couldn't solve it because the strange thing that you just have to take that step of introducing time-dependent costs, which is a bit unreasonable. Okay, so we probably didn't want to do this. By having this infinite horizon limit, actually there's no time horizon anymore. Oops. So then you kind of get rid of that. They only put a cost in the beginning. So they realize again that they can kind of press the oscillations. There's some interesting conjectures there that if you put the different extra cost and what they do, that there should be non-existent. So it's very much in line with our results. And probably with what we understand now, you could like redo all this in a high frequency setup and for the sort of get the same limits under those costs. So I think we kind of understood a little bit some things that remained open in those years' literature. Good. So let me conclude. Initially, I was very skeptical about this regularization. There are like a couple of nice papers, including recent ones by Eduardo Abijaber, Moritz Voss, Eyal Neumann. So depending on how we were approaching this problem, so they have this more functional analytic approach with kernels and stuff. If you look at it from that perspective, okay, regularization is convenient because spectral properties is better. You can kind of solve these integral equations. But it's not clear why financially this has relevance and so on. So I was a bit skeptical. Now, after doing this work, I'm actually more friendly towards the regularization. It definitely removes this subtleties related to the block trades that could come up in the game. Okay. On the other hand, we can take the limit to 0. We have to do it carefully. But if we understand, we can identify the limit model, and it's quite tractable. So it's fully explicit. That's nice. And I think the limit that we find, it kind of explains a couple of things that were in the literature before that were not understood, and maybe shows some of the conjectures that were around. Okay, thank you.